Hi, thanks so much for joining me. Hi, everyone. Today is August 6th, 2020. It's Thursday. And I have the pleasure of being joined by Kathy Jones. She is the Senior Vice President and Chief Income Strategist at Charles Schwab. And she does a lot of research at their foundation there. So without further ado, I'll be joined by Kathy in just a moment. Thank you. It's Highgrove, England, one of my favorite places to visit.
Yeah, it's gorgeous. Yeah, it's so green. Yeah.
Okay, so I did already preface this in case we want to use it, that you are Kathy Jones, Chief Fixed Income Strategist at Schwab, SVP. I love coming back to you because I know that you're a real research geek. And I wanted to start with that. You know, when we start thinking about how we get through all of this, I was just wondering, because I remember your prediction early in the game that we were in low interest rates for a very long period of time. Now, I know that that's expected to continue. But what I'm wondering is, in your research that you did for post-World War II, what got us out of that cycle? Did you have any comments on that? Just things that we might start looking forward to, you know?
Right. Well, it was a bit of a different environment in the sense that we had much stronger growth and stronger growth potential because we had a younger population, particularly when soldiers came back from war. There was a lot of pent-up demand because there hadn't been investment in housing or cars or any of those things. They got back from the war and there was tremendous demand for that, for just basic stuff that had either been rationed or just not invested in. So that was a big help. But it was also just a very patient kind of plotting from the central bank and keeping rates low for a really long time to work off the debt that freed up the budget for investment by the federal government. So we had investment in a GI Bill, we had investment in highways, we had a tremendous amount of fiscal support from the government, even at the same time that we were working to pay off the debt. So it was kind of a combination of sort of inborn demand that was driven by the return of soldiers, combined with the fiscal support from the federal government.
And a lower age in the demographic, right?
Absolutely, so, much lower, yeah.
All right, so bonds today. Can you give us 3 words that kind of give us the big punch on where fixed income is in the U.S. in particular today?
Negative real interest rates. I guess that's 4 words, but that's a highly unusual situation. So what we've got is very steady, low nominal yields and rising inflation expectations. Now, some of that has to do with the fact that we kind of cratered those expectations when the pandemic hit and the economy was shut down. So they're bouncing back, but they're bouncing back much more rapidly than nominal yields are in the bond market, which is giving us this negative real rates. And it's sort of signaling that the market's not really convinced that we're going to get enough traction in this economy for several years to get back on a positive growth track.
And what does that mean in terms of like just the average person that is trying to figure out how to get saved? You know, I mean, there is a strong push, people, especially with what you guys do, of talking a little bit about having a diversified portfolio and making sure you have enough saved. Now the question is, what's safe?
Yeah, I would say that I still believe treasuries, U.S. treasuries are safe in the sense that you hold them to maturity, you will get your principal back. Don't think the U.S. government's going to default on that. I think when people think about what's safe, they think about kind of what's the return going to be, right? Is there a possibility that if interest rates go up, the bond prices go down, and I'm stuck holding something yielding, 0.25% or 0.5% when interest rates that's the conundrum that we face, because we want some safe assets like treasuries that will counter the risk in other parts of the portfolio, but we have to reduce our expectations about what the return will be. So, you know, when you look at it, you sort of say, well, there's still a role for treasuries because they're liquid, they're safe, you can feel confident you'll get your money back, but you're not likely to get huge amount of money back, or you're not likely to get appreciation. You could see depreciation between the time you invest and the time you, those bonds mature. I would say one thing to do that we've suggested is just shortening the maturities or duration. So that the longer term, the more risk there is if rates rise that you're going to see the price decline. You could keep it just shorter term, so you still have that safety and liquidity, but you're not taking interest rate risk.
Are you suggesting, I mean, let's say, for instance, with munis, it's sometimes very difficult to get a short-term muni. They like to try to push it out. I've seen 50 years on some of these. It's been astonishing. But there's such, as you were saying, it's not, you know, it is the value of your bond potentially, you know, and also maybe liquidity in your bond, opportunity costs. So what about the muni market? What do you think about that market in particular?
Yeah, we think that the muni market, you could take a little bit more duration there. So in treasuries, you want to keep, you know, it's likely to be better off keeping a little bit shorter, but in munis, to get some yield, you need to go out maybe 7 to 10 years, something like that. I think if you're a buy and hold investor and you're buying high quality munis, highly rated munis, that it's still going to be a relatively safe investment. The risk of default is very, very low. Yeah, the yield is pretty low, but it's still going to generate some income. It's going to give you diversification from stocks and that tax exemption.
Are you at all, though, concerned, you know, with the loss of revenue that a lot of municipalities are seeing, and even potentially, I mean, you know, when people think of investment grade, you know, we have a lot of entities, both corporations and states, cities, that are investment grade, but can this pandemic put them at risk of a downgrade?
I do think there's a risk of downgrade. So what we've been suggesting is investors focus on the higher rated bonds, both in corporate bonds and in municipal bonds. I'm worried about the state and local governments because they're under a tremendous amount of stress from the pandemic, as you mentioned. They're losing tax revenue, and they're, you know, because businesses have been shut down, incomes have been cut or eliminated, and their costs are going up because they bear a lot of the brunt of the cost of this recovery, whether it's you know, services like firefighters and hospitals, as well as so we're worried about that, which is why we want to stick with the higher rated of the municipal bonds, the ones that if they were okay and secure and highly rated before the pandemic, they're probably going to be okay after the pandemic.
Are you considering like AA and AAA as highly rated then? And maybe underweight A's?
I think, yeah, exactly. And similar story in the corporate bond market. We want to stay in investment grade largely, you know, maybe high yield for a small portion if you can handle the risk, but we do see the risk of some downgrades. So you want to stay A rated for much of that. Maybe some triple Bs, but you don't want to get too committed to that space, because if they get downgraded, then they end up in the junk bond space.
And I mean, we can use, I know you do not normally want to talk about individual ones, but this event has already happened. What happens when a company, you know, a great legacy company like Ford goes from BBB down into, you know, junk space? What happens to your bond, and what do investors have to be careful of, especially in their BBBs?
Yeah, so that particular bond, that particular company, actually, their bonds are eligible for purchase by the Federal Reserve. So when the Federal Reserve set up these special facilities, they included corporate bonds most of which would be investment grade, but they actually took a handful of them called fallen angels that were downgraded as a result of the pandemic, and said that they would consider buying those even though they were below investment grade, and Ford happens to be one of them. And the reason the Fed is doing this is because these are usually major companies with a lot of employees, and they didn't want to see them have to lay off, tens of thousands of workers. So that was the idea behind it. But that's not going to be true. So other bonds, say they get downgraded from investment grade to high yield, the price will probably gap down, and you could definitely see the potential for, kind of a cascade. If the company's really in trouble, that could cascade into a default. So that's the kind of thing you want to be really careful about. Make sure they don't have too much leverage on their balance sheet, too much debt to repay, and that they're in a business that is, really harmed by this. So you've got tourism and some of the service sector companies, retail. Those are all industries that have really been hurt by the pandemic, and they're at risk for those downgrades.
Yeah, and I mean autos, Tesla seems to be a little bit of an outlier, but the auto, GM, Ford, both of them were off by 50% in their revenues this last quarter. It is rough to sell cars in a recession, especially with so much consumer debt. I don't know if you dive into this. I know you kind of stay more on the fixed income side than the equity side, but over half of the S&P 500 is at BBB or junk status. It's astonishing how many are congregated there. So I think investors really need to be aware of the fact that investment grade does include one rung above junk.
Right, exactly. And half of that universe is just one rung above junk. So we need to see the economy really ramp back up. Particularly given the high levels of debt that a lot of companies have on their balance sheets. They borrowed money because money was cheap, and why not? When things are going well, that makes sense. And now, of course, if your revenues suddenly decline, then it's harder to service that debt.
All right. So, we don't have to live here long, but let's go ahead and live here in the what if world. What bond lessons do you think we might take from the Great Recession, or maybe even looking back further to other periods of very high debt, maybe very high leverage, and very low growth or contraction?
Yeah. I think if you're an investor, the thing you want to watch out for is, leverage. Debt is great on the way up, and it really hurts on the way down. And it goes down a lot faster than it goes up. And so the benefits, take a long time to play out, and then suddenly it hurts. So I think if you're an investor, a couple of things to think about is, really know what you own, really stay on top of what's going on, whether it's a municipality, or a corporation. If you own the bonds, you really want to make sure you understand what the dynamics are in that industry and what the risks are. But the second thing is probably an undervalued thing most of the time is liquidity. And it's here for long periods of time, and it disappears really quickly. And if you can't sell your bond at a reasonable price in a reasonable amount of time when you need the money, that can really put you in a bad place. So a lot of what I'm seeing is, some suggestions people should veer out of, say, treasuries or other safe and liquid assets and go into higher yielding assets. Not a terrible idea, except that most of those assets don't have the liquidity that, say, treasuries do. So if you're going to need your money and you tie it up in private equity or some of these alternative investments, you may have trouble getting that money out when you need it. So you have to have that balance. And liquidity is one of the things we don't tend to think about. We tend to think about the potential reward, the yield, maybe the risk, but liquidity is one we tend to ignore.
I think that's a very good point. In fact, that's what has kind of astonished me about this. And you already alluded a little bit to it about the fallen angels and the Fed's support. The market's dried up. I mean, bond market, even treasuries, dollars, swaps were having trouble before the first stay-at-home order in the United States. So do you have any comments on that? Because it does to me seem, it's understandable theoretically that, yes, interest rates low, why not borrow the money, beef up your treasury? But on the other hand, we also know that low interest rates create bubbles. So on the financial stability side, we know that the Feds were monitoring it, but felt that it was sustainable. Do you think they went too long? I mean, I know they tried to raise rates in December 2018, and obviously the markets reacted very negatively to that. But do you think they just kept it too free for too long?
Yeah, I think there's a tendency, it's a judgment call, right? If you're at the Fed, at that, leading up to all this, the unemployment rate was falling, wages were starting to rise, but inflation was pretty quiet. The economy was really doing well. And it did, the benefit of that is sort of running a hot economy was that a lot of people got into the workforce, were able to get jobs who had not been engaged in the workforce. And there's a tremendous value to having people who have been on the sidelines be able to be in working, and there's tremendous value on many, many fronts. So I think they were really hesitant to pull the plug on that. But the trouble is that, the whole world changed, and they had to change as well when all that disappeared overnight. But I do think there was a tendency for them to be really tolerant and keep rates low for a long time because things were progressing nicely without a lot of inflation pressure. So they were sort of tolerating it and saying, yeah, maybe asset prices are a little overvalued, but look, we've got unemployment below 4%, something we think we could do. We're bringing in people off the sidelines we hadn't done in decades. There was a lot of upside benefit that sort of offset some of the negatives.
Let's talk a little bit about the other negative, the effective lower bound. And I know that may not be a phrase that a lot of people understand, but we did have a lot of cutting room in the Great Recession, and even in the dot-com recession, it helped us to get, boost the economy again. This time around, not so much. And they were aware of the fact that that was going to be an issue when and if we did hit headwinds. What do you want to say about that in terms of Main Street investors? They may not need to know what an effective lower bound is, but I know more about how that affects equities and also how it keeps your bond side buoyant. And the heyday in the dot-com era is the bonds were really earning, the value of them was increasing in addition to the yield. So do you want to speak a little bit to that how this recession is going to be different on the bond side than the last two were?
Yeah, it's a great point that there has been less room for the Federal Reserve to cut rates than the last time. So they're effectively at zero right now. The Fed has said that they don't want to go into negative territory because it's very difficult for the banking system to handle it, and it's not clear that the benefits would outweigh the negatives. But having said that, that means they have to use other tools. And what they've tried to do is use some of the other tools that they have to help support the economy. I think so far so good in the sense that they lowered reserve requirements for banks, so that freed up more capital for the banks to lend out. They expanded their balance sheet by buying bonds and holding down long-term interest rates. They took a number of very novel steps this time around. They created facilities where they could indirectly lend to companies and small businesses. They have provided US dollars to the rest of the world when the world was short of dollars. There's tremendous demand for the safety of the US dollar, and people in foreign countries, foreign governments couldn't get their hands on them. They provided extra dollars to smooth that out and prevent a crunch in the market. So they've used a lot of other tools, and that's what they're going to have to do. If things do get worse from here, which I hope is not the case, but if that were the case, they would have to come up with some new tools, I think, in order to support the economy, because lowering rates much from here just isn't going to work.
You know, that takes me to, I was reading, you know, what they had actually bought, and you mentioned how they've provided support for the lowest rung of investment grade. And a lot of corporations are getting support from the feds, but they've actually been buying up junk bond ETFs as well. So does that make it safer, or what is your thought on that?
I don't think it should make it safer. The market's acting like it's safer than it perhaps is. What the Fed was intending to do with that was to buy some of those ETFs to make sure that the junk bond market had liquidity, because it had frozen up, and some of those companies couldn't access the market to get funding. And junk issuers, they're smaller, highly leveraged, more speculative companies. They tend to have to roll over their debt periodically. Because no one will lend to them over long periods of time because they're riskier. So when the junk bond market freezes up, it's hard for them to roll over that debt, and that could cause them to default or go into bankruptcy. Again, something the Fed wanted to avoid. So just buying the ETFs provided liquidity to that market, but investors have reacted like, oh, well, it's all safe now because the Fed is buy them all up. I don't think that's the case. You can still see bankruptcies and defaults in there. So I just know what you own. Be very careful. You can. There's an old phrase from the previous crisis where one of the bankers said, as long as the music is playing, we'll keep dancing. You don't want to be the one left on the dance floor when the music stops.
Very, very sage advice. Well, I think that we have to also note what I've been seeing a lot, like a lot of people, even in their 401ks these days, are holding bond funds. And a lot of even investment grade bond funds can have up to 20% of either junk or mortgage-backed securities. Any thoughts on that? Like if you, let's say this was for your son or your daughter at their job and they just didn't know which one to check off, how would you align the safer, I mean, I know a younger person can afford to have more in the equities and have the longer term strategy, but on the safe side, what would you be looking at for them?
Yeah, so I would be looking for that balance between risky and not so risky. I tend to think the bond or fixed income portion of a portfolio is not where you want to take most of your risk. So if you have a relatively good allocation to equities, you're already taking a fair amount of risk, and that's the appropriate place for it. Usually the bond allocation is where you want to limit the risk. Now, I know everybody wants more yield, and you can only get it if you take a lot more risk. My preference would be if you're willing to take risk, you probably should be veering more towards the equity side of the portfolio. Now, within fixed income, if you're looking for more yield and you have the tolerance and the ability to take risks, you can look at things like preferred securities, lower rated bonds, emerging market bonds. Those all can make up a portion, but we usually suggest keeping that a relatively small portion, and the bulk of it being what we call core bonds, just treasuries, investment grade, corporate, and municipal bonds, where the risk of default or capital loss is pretty low.
In your last blog, which I read and I loved, you were talking about how a potentially weaker dollar could actually mean a higher yield without a much higher risk on the emerging markets. Do you want to talk a little bit more about that?
Sure. The dollar tends to move up and down in these long waves. So it's been moving up pretty much against most currencies for the last 10 years or so. And it looks like it's beginning to shift. And part of that is because the Fed has shifted to very low interest rates and has increased the amount of dollars in the world. So supply demand has shifted, and looks like the dollar is poised to maybe move a bit lower from here. And that typically is good for emerging market bonds. And the reason is that emerging market countries benefit when there's global trade, global liquidity, and also they tend to borrow a lot in US dollars. So if the dollar goes down, they're repaying in, their value of what they have is higher relative to what they have to pay back. All those reasons tend to be positive for emerging market bonds in sort of this portion of the cycle. Now, so if you want to look at that, we think that if you're willing to take the risk, and it's not for everybody because they can be quite volatile, there's still a lot of emerging market countries that are really feeling the pain of the pandemic, so you have to be a bit careful. But in an ETF that is broadly diversified, or a fund that's broadly diversified, we think if you're looking for more income and you're willing to take the risk, emerging market bonds should be at the point in the cycle where they start to benefit.
Now, I mean, emerging markets even include like China. Would you own an individual bond, or you just go for the fund, the bond fund?
I would tend to go for if you're an individual investor without, the specific expertise in this very niche market, I would tend to go for a well-diversified fund or ETF that gives you, a broad base. Or if you go to an actively managed fund with a manager who has a lot of experience in that space, it could be good. You don't want to end up with some of the bonds that are really problematic, like Argentine bonds or Turkish bonds right now. Those are, South Africa. There's some cases where you really don't want to be involved. And typically, the fund manager or in the ETF, you'll get enough exposure to a broad number of countries that you're not susceptible to a loss in one or two bonds.
I know we're kind of ending our time, but before we do, let's talk real briefly about deflation, inflation, hyperinflation. That's all over the map on that. Although you're saying that you're starting to see signs of inflation, and the chatter on the street is that people are afraid of hyperinflation. So what are you seeing short, mid, maybe even long term?
Yeah, so right now, I mean, we're still in this phase where we have had a big demand shock. And so that means that, people have lost their jobs, or they haven't been able to go out. And so prices fell pretty steeply when we went into it. Now, as we're coming back, we're starting to see a little bit of pickup in prices. And some of it's not so much demand driven as supply driven. We're seeing some supply chain issues push up the price of beef and pork and some of these other, particularly in the food area. So we're getting a little bit of inflation that way, but also as the economy grows, inflation tends to come back a little bit. So in the short run, we're not particularly concerned. We still think it'll stay low because we're still working our way out of a recession. Longer term, what we are seeing is expectations are rising, whether it's a survey or whether it's the market-based indicators. We're starting to see people expect that inflation to come back, and they're worried about it. And I think because Fed policies have been so easy that driven up those expectations that we will get too much stimulus to cause more inflation. And the Fed's telling us they want to see more inflation. So it's normal to expect it. Over the long run, I would not say hyperinflation. Fortunately, the U.S. has never experienced the kind of hyperinflation that Argentina or some of these other countries have experienced. But we could get higher inflation. Excuse me. So, we ran for many years in the 3.5% inflation category, and we dropped down to 2. Now we've dropped down to about 1.5. Over the long run, could we get back to 3% inflation? I think it's a possibility.
Okay. Which isn't really hyperinflation, so.
No, it's higher than we had for a while, but it's really different than where we are today.
Definitely. Do you think that we're at risk of our AAA? Well, Canada just got downgraded to AA by Fitch. What about us?
Oh, I think we are. We've already been put on notice by a couple of the rating agencies. But one thing I'll say is part of the motivation is we're running these big deficits. And not only are we running the deficits, but we don't seem to be indicating that we're willing to do anything about it. So, it's one thing if you run a deficit because it's a recession and once the growth picks up, once the growth picks up, the deficit will come down relative to the size of the economy. You kind of get it in balance again. We're just on a path that shows rising deficits, and there doesn't seem to be any political will to deal with that or make a plan. And I think that's what the rating agencies are telling us, that if you don't at least come up with a plan or show some concern about it, that they're going to downgrade us.
Yeah, I mean, it's just, the debt is much, much, much higher than the other AAAs in there. They've been saying that for quite a while, and the only saving grace was that we're global currency, and they thought we had political will, although we didn't have a political plan. Any last?
I would. Yeah. Go ahead.
I was going to say, do you have, I want to mention one last thing, and it may or may not, because I think you might know the legal, whether or not this is even something we can legally do here. We did see some redemption suspensions in mutual funds in Europe. I've seen some conflicting, I know in money market funds can now have redemption gates and liquidity fees, but I've seen some documentation that says that most mutual funds do not allow that. And what is any comment on that?
My understanding is that it's relatively specific to the fund, so they can build in different provisions when, in their legal documents. So it is one thing to watch for when you're looking at a fund. Could they do this? Could they suspend, tie up your money, basically? Now, sometimes, I want to say this carefully, but sometimes it's not necessarily the worst thing when they do that, because sometimes people panic and sell something in an illiquid market, and if they can wait a day or two or a week or two, it comes back, and that can sometimes be a mistake, and oftentimes the gates will prevent that from happening. On the other hand, it's a very uncomfortable feeling when you can't get your money when you want to. So, you really have to look at the specific fund and see what they've written into their prospectus, into their filings, so that you know what they're able to do.
Sounds good. Read the fine print, folks. That's a lot of fun. It definitely works well as a sleeping tool. Any last comments?
I would say these are really kind of difficult times for people. In many, many ways, but one of the things you can do is kind of control what you can control, and sit down and look at your portfolio and say, well, what can I do to make sure I have some cash on hand if I need it, if I get laid off, or I have a problem that needs to be addressed. Make sure you have that comfort level with everything you invest in. And now is a great time when we've got a little bit of a lull, markets are doing a little bit better, everybody's calming down. Now's a great time to look at that and say, what made me uncomfortable in March? Mm-hmm. Do I want to change my allocation so that I'm more comfortable? Or do I really understand the risk that I was taking?
Do you think it's also a good idea I know that in Europe, it's not the same. In Europe, families tend to think intergenerational wealth. And here, I think we have people very segregated and by the generations. Would you be looking out for your parents and maybe looking over the shoulder of your kids a little bit?
Well, yeah, I do. I mean, every family dynamic is different, but I think that having certainly a long-term plan that incorporates what you might want to do as a legacy for your children, or if you have elderly parents that need some support in one way or another, that's something you should build into your plan. If that's part of what you want to do with your money, it's an important thing to plan for. And it always comes back to kind of, what are you planning for? What's your money for? It's your money. Figure out what you want to do with it and make a plan to be able to do what you want to do with it.
Great. Thank you so much for your time. If you have any last words, we'll hear them, but you've given us some great information and a good plan too. Thank you.
Well, it's great talking to you, Natalie. Thank you.
Goodbye. All right, gang, you can watch a playback of this at youtube.com/Natalie Pace. You can share it. It's public and it's free. And you can also follow Kathy Jones commentary. If you Google it, just Google Schwab, Kathy A. Jones, you'll get her comments. And what are you doing? About once a week, a new blog?
Yeah, yeah, something comes out about once a week. So.
Yeah, and it's free. And she is one of the most respected fixed income strategists. And as you can see, she's honest and truthful and transparent. So you get good things from her.
Great. Okay.
Thanks,
Thank you so much.